Hi, I'm Linda Eedes from Foord Asset Management, and I'm joined today by Wim Murray. Wim is one of the portfolio managers for the Foord Equity Fund, and one of the asset classes that you actually can invest in within that fund, but it also finds its way into our multi-asset funds, Wim, is property. Now, it's not an asset class that we've spoken much about recently. Of course, property went through quite a tough time initially in 2018, and then it was dealt another blow through COVID and the implications that had for the sector. Let's just start with how we view property as an asset class.
So traditionally, the thinking around property has been it's sort of a hybrid between fixed income and equity. So if on the 10-year government bond you get 11.5%, for equity you would require maybe 5% equity risk premium. And then for the property segment, it's somewhere in between. So you require roughly a 14% return on your capital in order to be interested. Now, the thinking has been it's a stable income stream that you derive from the property. There's leases in place and you're able to pass on your rentals and escalate them roughly by inflation over time. Now, of course, this hasn't been true for the past 5 years, and we've seen immense volatility within both the property counters, but also the underlying distributable income. And that has been driven in part by the soft macroeconomic factors we've seen, but also excess supply that sits within some of the property counters and the specific asset classes. And then you overlay with that some of the cost of doing business that have gone up with municipal rates and taxes, electricity. So all in municipal cost has gone from around 19% of your gross income for property counters to about 26%. So that means it just eats into the distributable income that's actually being paid out to investors. So it's been a very tough place for the equity holders to be the past 5 years. And we're fortunate that our weighting within the sector has been very low during this time.
Now, Wim, as I mentioned, it had a serious drawdown in terms of the prices of those listed property companies. It is off its COVID lows, so it has seen a bit of a recovery, but it is still very low compared to where it peaked in 2017. Why are we still avoiding this asset class broadly? We have very low exposure. We have started to take a little bit more of a nibble, but it is still very low in our equity fund as well as in our multi-asset portfolios as well. What are the risks that we see still in this sector?
So as mentioned, the moment you have excess supply in the system, it's very difficult to predict how it actually plays out. And when an underlying factor in your thesis of owning the asset is the stability of the income, then that becomes quite a big factor. So we expect there to be some dominoes still to play out within the property sector overall. You overlay with that high gearing that sits in this asset class. In order to get a sufficient return on equity, you actually find that the property companies gear up quite a bit and they use the debt in order to finance the acquisition of these assets. And the moment you have a muted net operating income combined with increasing interest rates, then you do see your distributable income take quite a bit of a knock. So in part, that's the one factor that do concern us. Then there's also been fairly aggressive accounting being used by a wide range of these property counters. So we think the actual distributable income, when you look at the cash flow coming from these assets, in some instances are quite a bit lower than what would be reported in the income statement that we as investors receive. And then on top of that further, we have the government bonds increasing in yield over time. Now, we believe that over the next 5 years, there will continue to be pressure on government financing, which would mean that a long bond yield is likely to stay at elevated levels for some time going forward. We've yet to see that reflected in the property assets valuation. So it's still very much the cap rates that's used to value the properties haven't ticked up by much. So we're looking at 2018 levels still being reflected. And at some point, that shoe needs to drop. And effectively, what will happen is you have a geared entity where your property valuation needs to come down, and you find that the gearing that existed, the loan to value is actually not 44%, it's above 50%, and you're getting into a very precarious position where you actually need to start writing down some of the assets aggressively. And you can also make the argument whether the business model continues to work at these higher levels. So when you look at the spectrum of assets, we are very cautious of the lower quality assets and very cautious of those that do have high gearing and aggressive accounting to them. So it's definitely a segment where you need to do very detailed bottom-up work in order to have certainty.
And so then it follows, Wim, what would we want to see in order for us to actually consider allocating a bigger portion of our portfolios to this asset class?
Yeah. So there's two factors we spend a lot of time on. The one is, as mentioned at the beginning, the stability of the income going forward. So you need to have quite high visibility in terms of what you believe these assets can actually generate. So the quality of the assets become paramount to the investment case. We think with funding costs moving up and with excess supply falling over, the strong are likely to get stronger over time. So that would be the first factor. Then secondly, low gearing is extremely important. We do not want to partake in companies where they've actually geared up in order to achieve some of the distributable income they now claim to earn. And then the quality of the underlying management and both the distributable income. So we look very closely at the cash flow and we take it on a company-specific basis. As you mentioned, there's been certain instances where we are willing to increase our weighting, and we continue to nibble as time goes on. But stability and certainty in terms of visibility going forward, and then actually not overpaying for these assets, we think is the right approach in the current environment.
Okay, thanks. Thanks for your contribution, Wim. And thanks to everyone who's joined us today. I hope that this has given you a little bit of insight into how Foord views property as an asset class, some of our views on property at the moment. Thanks again for your time, and take care.